Hey everybody, it's Jack and welcome back to another video. Another week is in the books, so therefore it's time for another portfolio update video. As always, in this video, I'll go over the stock market in the week that was, as well as all the stocks that I purchased last week. And then we'll jump into my portfolio breakdown. I'll show you all of my current holdings. And then at the end of the video, we'll go over my weekly watch list for the week ahead and show you all the stocks that I plan to add next week and why. It was a pretty crazy week over the past week for the stock market. We saw some big swings up, some big swings down, and I ended up being around even for the week. I'm really curious to see how all of your portfolios did, so let me know down below in the comment how your week was. We are currently kind of in earnings season for quarter one of 2021. Last week, we saw a lot of the US companies as well as big tech come out with their earnings reports. And over the next few weeks, we're going to see the majority of Canadian companies release their quarter one results. So there's going to be a lot of excitement and movement in the stock market. So brace yourselves for that, definitely. Before we dive into my portfolio and I show you all of my stocks, I quickly want to go over the giveaway winners from last week's portfolio update. In last week's video, I held a giveaway for 2 premium TipRanks accounts valued at around $400 to $500 each. All you had to do to enter the giveaway was to comment on the video explaining one lesson that you've learned through investing in the stock market. It was truly crazy to see all of you guys comment. There was over 400 of you who commented one thing you've learned in the stock market, and it was honestly great to see. I did my best to respond to every single comment. I think I responded to over 400 of you guys. So I really did my best to make sure that I responded to all of you that took the time to comment. And there were some really great things in there to really share some great knowledge of what everybody has learned through the stock market and through investing. So I definitely recommend going back to that video and see if you have learned the same lessons or if there's maybe a few that you guys can pick out and actually learn from as well. So the first random winner is Charles, and he left an awesome comment. His comment was, "Through those countless times where I was looking to enter a position, but I waited to see if a stock would dip more, I've learned that time in the market beats timing the market." And this is a one that a lot of you guys commented that you have learned and really talked about how patience is key when investing and that time in the market beats timing the market, which is a famous quote. And I definitely agree. This is one that I've learned as well. You know, sometimes you'll set a limit buy for 10 cents below the current price. It never hits, and then the stock shoots up $2 or whatever it may be. So that was a fantastic lesson that Charles shared, and I think one that so many people have learned over the years or even in the short time that they've been investing. So congrats to you, Charles. You're the first giveaway winner. And the second giveaway winner is Caitlin. And Caitlin had another great comment. She said, "Hello, I just started investing about a month ago. One thing I've learned is just how much passive income could be coming in from just dividend stocks alone after investing for 20 to 40 years. I didn't realize you could potentially live off strictly dividend income upon retirement." So this is a great comment. Thanks, Caitlin. And this is really what I'm trying to show every single week. By adding a few dividend stocks to your portfolio, you're going to boost up your passive income. And over time, those dividend stocks and payments will be able to buy more dividend stocks. And it really begins to snowball over time and add up quick to the point where you can retire off of your investments purely from the passive income generated by your dividend stock. So Caitlin and Charles, all you need to do to get your free premium TipRanks account is to shoot me an email. You can find my email in the description of this video. Just scroll down, shoot me an email saying, "Hi, I'm the giveaway winner," and we'll get you set up with your premium account over the next few days. So now jumping into my account status, which I'm just going to be quickly whipping through because I want to cover a case study that goes into why I own the certain type of dividend stocks that I do, which are dividend growth stocks, opposed to your kind of split share funds and really high earning dividend stocks that have those 8, 10, 12% dividend yield. But first, my account status. My account currently sits at $4,602. I had a pretty even week this week. Over the prior weeks, it was mostly my growth stocks that were bringing me down and my dividend stocks that were doing really well. This week, we kind of flipped the switch and my growth stocks did pretty well overall. And then my dividend stocks actually kind of brought the account down. So we finished Friday down $28, 0.60%. On the week, we were down around 0.2%. Which means all time we are now up still $37.56 and 0.82% all time. But this does not count in the actual dividends that we've beginning to earn, as actually in the month of April, we've started to see those dividends come in, getting over $8 in dividends, which I know doesn't seem like much right now, but over time, this is really going to start to snowball and really start to increase. And each and every month, we're going to be getting more passive income coming in. A lot of you guys have been commenting on my previous update videos asking about split share funds or income funds such as ENS or DFN or Canoe EIT. And I'm going to be going over why I do not invest in these income funds that offer that 8, 10, 12% dividend yield. And I'm going to be covering why I go for the dividend growth stocks such as your banks like TD, your utilities companies like Fortis and AQN, as well as your telecom companies like TELUS and Bell. I'm going to be going into why I rather invest my money into these stocks instead of those high generating and high yielding income funds. First, I want to come out and say that if you're somebody who's either retired or you're investing purely for cash flow and cash generation, then these split share funds or income funds can be a great source for that because they do offer that really high dividend yield. So you can continually be pulling out that cash if you need it for a rent or to survive, things like that. These can be good options. But for somebody like me who's investing for the long term, we're talking 20, 30, 40 years, even more, I would rather invest in these dividend growth stocks that have a smaller dividend yield, but they increase their dividend payout every single year, and they increase them by pretty substantial rates. We're talking 6, 8, 10, 12% each and every year, and they go up in share price over the years. They actually appreciate in share price, whereas the counterparts, the split share funds and the income funds, I personally find if you look at their max charts, they either trade completely sideways and stay in the same kind of share price year after year, or they actually decrease over time and go down in share price, which for someone who's investing for the big picture, 20, 30 years. So I'm now going to jump into this case study and actually show you how by investing into these dividend growth stocks that increase their dividend payouts every single year, if you buy these stocks now, today, and hold them for 10, 15 years, you're actually going to be getting the exact same dividend yield in the future of that 10, 8, 15% dividend yield by holding these stocks like your Canadian banks, your telecoms, and your utility stocks. So first, taking a look at DFN, one of these split corp funds, we can see that it currently has a dividend yield of 15%, which is crazy high. But if we look at its actual max chart, we can see that historically it just continuously slowly declines over time. So yes, you are going to earn a lot of money in the passive income from the dividend, but you're going to be fighting against the depreciation of the actual share price over time, and it's definitely going to take away from some of your gains. And the same goes for Canoe EIT Income Fund, ticker symbol EIT, currently has an over 10% dividend yield, but again, looking at the max chart, you can see that this one just slowly declines over time. So both of these stocks have declined over the past decade, 20 to 40% in share price. And now comparing that to our dividend growth stocks, such as Algonquin Power and Utilities, AQN, which currently trades around $20 per share and has an annual dividend of 78 cents, which is 3.92%. If we look at the max chart, we can see that a decade ago, Algonquin Power was only $5 a share. Since then, it's gone up over 400% to around that $20 range that it is today. Now comes the fun part. Algonquin Power has been growing its dividend payout every single year at a historical rate of around 10% annually. So what this means, if you bought Algonquin Power back in 2010, when it was trading around $5 per share, the annual dividend payout was 21 cents. And at the time, the dividend yield was sitting at 4.2%. So if you had bought shares in 2010 of Algonquin Power and you still held them today for an average cost of around $5, so this is assuming you don't continuously add to your position and dollar cost average up, those same shares that you bought over 10 years ago would now be paying an annual dividend at the current rate today of $0.78, which would give you a yield on cost, a dividend yield for those shares that you bought a decade ago of over 15%. So you can see that by getting these dividend growth stocks that continuously every year increase their dividend, you can earn over time the same dividend yield as those high income funds while still seeing share price appreciation. Because remember, Algonquin Power and Utilities has gone up 4 times in share price since 2010 from $5 to around $20, whereas the high income funds, Canoe EIT, your DFN, they've decreased 30 to 40% over that same time period. So this is why I choose dividend growth stocks. This same example applies for other dividend stocks in my portfolio, such as Fortis, which has been increasing its dividend for 47 years straight, as well as TELUS, which has a really great dividend growth rate. So hopping right into my Google Sheets spreadsheet where I track my passive income and my portfolio breakdown, which as always, you can download the link to this Google Sheets spreadsheet in the description of this video for totally free. So hopping right into the stocks that I purchased last week, I purchased one share of Algonquin Power and Utilities. Again, one of those amazing dividend growth stocks. So I only picked up one share of Algonquin Power because it dipped quite significantly. You can see that I'm currently down 4.7% on Algonquin Power. It went from being in the mid 20s down to $19.83 is where it currently stands. So I picked up one share to continually average down, dollar cost average lower into this position, because it's one that I'm very passionate about long term. And as you can see, it makes up 9.1% of my portfolio. And then the main stock that I picked up last week is the second one on the list, which is Fortis. This is another utilities company that again has been consistently raising its dividend for 47 years straight. I picked up two more shares of Fortis, so I now have 5 shares and it makes up 6% of my portfolio. Last week, I really focused on adding to positions that were small in weighting within my portfolio to help boost them up, and Fortis was one of these. So continuing on, the next stock that I picked up last week was I picked up one share of TELUS, another dividend stock that has a great dividend yield sitting at 4.86% currently. I added one more share to my TELUS position. I now have 16 shares, and I'm currently also down on my TELUS position, which again is the reason I added another share, just dollar cost averaging into some of these really great stocks that I have high conviction in long term. I really see TELUS continuing to grow in share price as well as that dividend. And then the last stock position that I added to last week was one of my growth stocks. It's actually my newest growth stock, which is MCI One Health Technologies. This is one that I currently don't have too many shares in and is the smallest position within my account. I currently only have 25 shares. So last week I picked up around 10 to 15 shares of MCI One Health. And this is one that I'm going to continuously add to over the coming weeks by just picking up 5 shares here and there, as I'm still dollar cost averaging into this brand new position. And to just quickly point out a few noticeable stocks within my account that had big movements last week. The first one being Brookfield Renewables, BEPC. This renewable energy stock has swung over 20% down in the past few weeks. So definitely some noticeable movement in BEPC. It currently makes up 6.7% of my account, but this is one that pays that lower dividend, sitting at 2.24%, but is a really great growth potential over the coming years as that shift towards green energy starts to really pick up. So again, this is not one that I'm worried about, and I'm just going to continue dollar cost averaging over the next few months if it remains at these really low prices. And then the one that is most noticeable that we should mention was Standard Lithium. Standard Lithium last week went on an absolute tear. It went all the way up to $4.70 per share. It then since dropped back down to $4.21. So a very significant drop. It dropped over 10% from the highs that it was seeing at $4.70. And at that moment in time, I was up around 25% on the position, around $125. And as you can see now, I'm only up 11% and $55 in total gain on this position. So it definitely some big movement in this one, but I did not sell any of my shares. I think Standard Lithium will uplist to the NASDAQ into the United States Stock Exchange over the coming year. And I'm really excited about this. And we saw over the past few weeks with a stock like MindMed that uplisted to the NASDAQ, the extreme volatility and the surge it saw when announcing that it was uplisting. And jumping into our dividend tracking, we can see that by adding a few dividend shares over the past week, I was able to increase my annual dividends to $109.22, up from the previous week of $103. So we added $6 to our annual passive income by adding those few dividend shares. And our monthly average went from $8.60 up to $9.10, a 50-cent increase. And remember, this monthly average passive income boost is going to be seen every single month for the rest of our life. So adding 50 cents to our monthly income for the rest of our life is huge. Again, this is how we're going to be able to generate that passive income that one day I can retire off of. So it's pretty exciting when you look at it that way. So now hopping into our portfolio breakdown, again, as always, you can see that my top 4 stocks, my top 2 growth stocks are Standard Lithium still and H2O Innovations, but have been slowly coming down in their overall weighting. And my 2 main dividend positions, or 2 largest I should say, are Algonquin Power at 9.1% and TELUS at 8.9%. So 2 great dividend growth stocks. Now looking at the sector allocation chart, this is going to be the chart that's going to heavily influence my weekly watch list for the week ahead, because as you can see, I'm heavily in the renewable space right now. That is my largest sector, sitting at 21.6%. with my mining and metals at 15.9, as well as my utilities at 15. Those are my top 3 sectors, which combined make up around 50% of the portfolio. So my weekly watch list for the week ahead is really going to focus on adding to some of my sectors that are really lacking in their overall weighting. The financial sector I want to point out specifically because it's only sitting at 3.7%. And this is the Canadian banks and the insurance companies. So I really want to add to these positions, which leads us perfectly into the weekly watch list. So the first growth stock that I want to focus on adding to over the following week is my NASDAQ 100 ETF, QQC.F. I want to add 1 share below $114. I really want to start boosting up my US stock exposure, which I currently get exposure to through my NASDAQ 100 ETF, as well as my S&P 500 ETF. So these are great ETFs to get US exposure as a Canadian investor. And the second growth stock position that I want to add to over the following week is my MCI One Health that I've been talking about, DRDR. This is a company that I'll be doing a full analysis and breakdown of over the coming weeks that I'm really excited about. And I've still just started this position, so I want to continuously keep adding. So I'm going to be adding 5 shares, hopefully below $3.10 to average down my position. And if we now jump into my dividend stocks on my weekly watch list, I have Manulife Financial. This is a new stock that I'm going to be starting a new position in. Again, this is a great dividend growth stock that has been seeing great dividend growth over the past 5 years. As well, this will give me more exposure to the financial sector, which I mentioned that I'm currently lacking in and is currently one of my lowest sector allocations. Not only this, but Manulife currently offers above a 4% dividend at the current price, and I think its current share price is quite appealing. So over the coming week, I'm going to be looking to add 1 or 2 shares of Manulife Financial. And my second dividend stock on my watch list has been TD Bank. This is one that's been on my watch list for the last few weeks because I'm continuously keeping an eye out on it as I want to add 1 more share. Hopefully, fingers crossed, around $83. We see the banks that have just been continuously going up and up and up in share price, but hopefully we see a dip at some point, and I do want to continuously add to this, as again, this is another great Canadian dividend growth stock that continuously increases its dividend year after year and increases in share price consistently. So there you have it. There's my weekly watch list for the week ahead. I plan on adding to my ETF positions, especially my US ETF positions, such as the S&P 500 and NASDAQ 100 index funds, as I want to increase my exposure to US stocks. I also plan on starting a new position in Manulife Financial, another great Canadian dividend growth stock that continuously raises its dividend over the years and currently at this moment has an above 4% dividend yield, and I think is currently trading at a very nice price. So again, I hope you guys enjoyed this video. If you did, smash that like button, subscribe to the channel. Lots more really awesome content coming over the next few weeks. So you're going to want to stay tuned for that, and I'll see you in the next one.